Now I will be talking about the chapter 7 of CFA Investment Management Certificate 2013. This video is to help you pass an exam, but you also need to read the book so to make sure you pass at the first attempt, hopefully. The chapter 7 is a client classification. When you conduct investment on behalf of the client or your own behalf, you need to classify the clients as recommended by FSA, Financial Services Authority, and under the Marketing Financial Instrument Directive, which has two main categories of clients and separate and distinct third category for limited range of business. The market have retail clients who are past their wealth to be managed by professionals, firms and other authorized by FSA. Professionals clients are considered to be more experienced, knowledgeable, and sophisticated, and able to assess their own risk and are afforded fewer regulatory protection. Eligible counterpart (ECP). Those are investment companies, credit institution, insurance company, and the UCTIS, which stands for Undertaking of Collective Transferable Investment Security. And for those companies to act in any country within the European Community, they must have the passport that is granted by MiFID, which is Marketing in Financial Instrument Directive. They assess the company. If the company are able to afford invest in one country and another, and perform financial activities in other countries as far as within the European Community. There are some requirements for the companies have the passport, which is a balance sheet, the turnover, and their share and their funds. Everything depends on the capacity of the company dealing with one country and the others, and can support in case of some crisis come along and they are able to be standing. So you also have a per se professional clients who are formed by professionals in investments with passports. Some are without, and the passport is required when institution want to operate from one country to another, as I have just mentioned here. So if you are a large business, let's assume one company in Germany, which does not deal with investment, but they want to invest in UK, part of their wealth they want to invest in France or Italy or so on. They must have a balance sheet of at least 12.5 million euros on their balance sheet, and their turnover must be at least 25 million euros a year, and an average of 250 staff. If the company provides all this, they shows it's a massive company. They have a right to invest their wealth in others member of European Community. This is just to invest into other country, according to MiFID, with Financial Market Instrument Directive. But if the institution want to operate fully, they need to have, like I have just mentioned before, if the company has the investors and the people who are able to assess risk and professional of investment, mainly someone from the CFA. The requirement for those companies act from one country to another, buy shares, buy securities, buy T-bills, T-bonds, and so on. They must have at least their balance sheet of 20 million euro and their turnover at least 40 million per year, and does require the number of staff, because those companies they run the company with fewer staff rather than like just I have just mentioned, if VW or Mercedes or some of those companies, if they want to invest in other country, they can do it, but they are not uh, investment. The investment activity are not their main source, so they can become an investor anyway. So in the say this company to have the passport to invest from one country to the another, as I have just mentioned, I'm gonna say once more, they must have the balance sheet of at least 20 million euro, 40 million of euro of turnover in a year, and they own at least 2 million in funds. Or the firm may classify its clients that gives reasonable assurance that the client is capable of making his own investment decision and undertaking the risk involved. Also, if the client states in writing that they are aware of the risk, that's fine. But even though your company, where company you work with, if you get a client that is able to assess their own risk, and knows all about the investor protection, that's per se responsible. So every transaction must be placed in right. The firm must warn them about all of it, in protection, investor compensation, uh, because as you put everything in right, they will know they may lose in that stance, because they run their own investment, they can assess, so they are aware, but at the same time they earn more return. But in case of any risk, your company would not take responsibility. The eligible counterpart, which is your assume your company you are working with, they may share the investment and take all risk involved. But if any security that you buy and eventually run at loss, you have to refund your clients. But in the case of per se responsible, you don't have to. The client agreement: when a firm enters into a deal with a client, the firm must warn the client about all concerns and the destination of the investment. So every funds you get from the client, you must let them know where the money goes to. So the investment is fully clear. You must leave it everything in clean cup. Clarify every step by step to your clients. The inducement is under the conduct of business rules governed by Financial Finance Instrument Directive, Business Firm must act honestly, fairly, professionally, and in the best interest of their clients. Also, disclosure all step by step, I have just said. Also, all expense and fee that involved over every transaction, right? So now I'm going to start saying about section 2. Propose and scope of finance promotion rules. The financial promotion is an invitation or inducement to engage in investment activities that is communicated by TV, by email, by so anyway, communication. So in the section 21 of Financial Market Service Act 2000 impose a restriction on the communication of financial promotion by authorized person. A person must not invite or induce the others when they are not authorized. Communication is considered when there is a use of printed advert, radio broadcasts, personal visit, phone calls, emails, internet, and digital television. Fair, clear, and not mislead communication. A firm must make sure whether the communication is fair and clear. The FSA must be displayed, giving full awareness about the product and service. Client's capital risk and the underlying asset must be disclosed and show what type of risk the capital is exposed. Communication with retail clients include the name of the firm, gives the accurate information over the product, don't emphasize any potential benefit, make it clear so the client can understand. Do not use technical language. Make sure the comparison is really fair and meaningful, and presented in a fair and balanced way. In respect of a particular tax treatment, the firm must ensure that it prominently displayed that the tax treatment depends on the individual circumstance of each client that may be changed in the future. Cold call should not be made unless the recipient has an existing client relationship with the firm. The firm must also make sure if the communication complies with the financial promotion rules. A firm must keep record of every financial promotion, definitely for pension scheme. So for pension scheme, you keep it forever. For 5 years, you would keep for life policy, occupation pension scheme. 5 years for market in financial instrument directive, and 3 years for any other institution. Investment advice, charge and remuneration. As from the end of 2012, the advisor can charge the retail client as agreed. Section 3. Firms provide investment for clients and other ECP, which is eligible counterpart. Before the firm make any recommendation, the firm must know the investment objective, their financial situation, their knowledge and experience. A firm must provide a suitability report to our clients. If the firm makes a recommendation on buy or sell shares, return and show all possible outcomes into that investment. Or churning. Churning means when you have an investment to make but does not produce the expected return, but you buy it anyway. Eventually you switch to another one that you assess and come to know that it provides a better return. So you churn, then you switch. Appropriateness obligation, as the firm gives recommendation, also make sure if the client is aware about the investment that they are engaged in. Research and suggest when give recommendation. Now, section 4, product disclosure package. Products, a life policy, an interest in investment trust saving scheme, unit in a regulated collective investment scheme, a personal pension scheme. All these a type of product are available on the investment market. Where a firm provides advice on packaged product, it must disclose where it expects its scopes to be. The whole of the market or market sector limited to several product providers, limited to a single provider, must be large enough to satisfy the client, as the FSA does not specify how identify what is sufficiently large is. The Financial Service Authority is the independent financial service regulator. It requires us read the document carefully so that you understand what you are buying, and then keep it safe for future reference. Include enough information about nature and the complexity of the product. An arrangement for complaints about the product. The language must be easy. I say once more, cannot use technical language. Must be easy language so the clients can understand and see everything clear. He cannot take doubts anyhow. Well, this section 5 tells us about fiduciary duties. This is happening when an investor rely upon that person, so that person must act on behalf of the investor and undertake and responsibility that concern the interest of the client. The person we call fiduciary, who is his own discretion and expertise in order to act for the client. Custody of client's asset. The custody rules require a firm to arrange an adequate protection for asset for which it is responsible for all the investment they have done and the responsibility around his client in case of insolvency. So the firm cannot enter into an arrangement for security financing transaction unless the client consents. So they cannot put the client asset in guarantee of insolvency without the client consent. Or the reconciliation. If a client came to agree that he's gonna allow one of his assets to be in guarantee of any debt, that asset must be specified which ones and date, maturity, and all detail about that particular asset. A firm should keep internal control of the financial instrument held for each client. Client money. The firm, on receive any money from his client, must place this money into one or more accounts opened with any of the following: a central bank or BCD, a credit institution, a bank with a registered office in economic European area, state, and subject to the Bank Consolidate Directive. So the BCD stands for Bank Consolidate Directive. In case something goes wrong, the money is guaranteed. Finally, section 6, firm must take all reasonable steps to obtain the best possible result from their clients when executing orders.